So as you can see in this question, the statements of financial position of the parent company and subsidiary company as of 30th June 2008 are given below. Okay, so here's the balance sheet for both of these companies. And it says in the further notes that P has acquired 60% of subsidiary on 1st of July 2007 when the retained earnings of subsidiary were 5,800. So basically, if you can look that it's the date of acquisition is exactly 1 year before the reporting period, right? P paid 5,000 in cash and also issued two $1 shares for every five acquired in subsidiary. So not only it gave a cash consideration, but it has also provided with share based consideration in order to acquire the subsidiary company. It has also agreed to pay a further 2,000 in 3 years' time. So that's a deferred consideration. The market value of P shares at 1st of July was 1.8. So this information you will need it to calculate your share consideration. But then there is also, as I told you, that there is also a deferred consideration. Now, this point is very important over here. It says that P has only recorded the cash paid in respect of the investment in subsidiary. So as you can see in investments over here, we have this 5,000. That's only the cash consideration. So the deferred and the share consideration is not recorded. And while you're consolidating the balance sheet, you have to ensure that you do record the number of shares which have been issued by the parent company and the deferred consideration liability of the parent company. They have also given you with the current interest rates, which are at 6%, and that information is required to find out the present value for the deferred consideration, because you won't be writing it down in the future value. You have to convert it into the present value, and then there will be an unwinding of discount too. As far as the goodwill policy is concerned, it says that the P group uses the fair value method to value the NCI, and at the date of acquisition, the fair value of the NCI was 5,750. Okay. So all of this information has been provided along with the individual financial statement, the balance sheet of both the companies, and the requirement is to prepare the balance sheet of the group as at 30th June 2008. So while we are starting our workings, the first working is going to be your group structure. Parent is P company, subsidiary is S company. The date of acquisition is 1 year before. Okay, so that's 1st of July 2007. Percentage of ownership is 60, and your NCI is 40. Okay. So once you have prepared the group structure, now we have to move on to our next working, which is your net assets of the subsidiary. At here, it's the acquisition date, and here it's your reporting or the balance sheet date. So let's see, what do we have in the net assets? Like the equity, we have the share capital. We don't have share premium for the subsidiary, so it's fine. We do have retained earnings though. So we have two things only in the net assets, the equity, which is the share capital, and the retained earnings. So the share capital, and we have the retained earnings. Okay. So for the reporting date, as you know, we can just simply copy paste from the question, which is 5,000 and 7,200. So this turns out to be 5,000 and this turns out to be 7,200. You can simply add both of them and you will get the net assets at the reporting date, which is 12,200. And as you know that this figure will be used while we are calculating the NCI. But as far as the acquisition date is concerned, the share capital will remain same, okay? Because after that it has been acquired. So that will remain at 5,000, but the retained earnings at the acquisition date are given to you in the question, which is 5,800. So over the period of time, you can understand that it has increased from 5,800 to 7,200, and that's going to be the difference. Okay. So the net asset at the acquisition date will be 5,000 plus 5,800. So that will give me 10,800. So if for the goodwill calculation, I will be using 10,800. For the NCI calculation, I have to use 12,200. And the difference between them will be used for your group retained earnings, which is 1,400. So once the parent has got the control over the subsidiary, after that, in that 1 year, the retained earnings have increased by 1,400, which is mostly likely due to the profit and in case if any dividends have been paid. So that's 1,400 over there. Okay. So that's what you are supposed to do for working number two. Now, after we have done for our working number two, we will jump to working number three, which is to find out the goodwill. And as you know that we have a policy over here that we need to find out the goodwill of the controlling interest as well as the NCI part. So together, like we need to report 100% goodwill. So first I'm going to work out for that 60 percentage, which is the controlling part, okay, controlling interest. And for that, I need to find out the cost of investment. And we know that we have three things which are forming the part of the cost of investment. The first one is your cash, which is a straightforward figure of 5,000. Okay. Then we have your share consideration. Now, see, it says that we have issued two $1 shares for every five acquired in subsidiary. Okay. So let's see how many shares do we have in S company. So S company basically has 5,000 shares because I told you that you have to figure out the nominal value over here. So that is 5,000 divided by 1. So that's the number of shares which we have, 5,000. But then we acquired around 60 percentage of the capital. So that gives you approximately 3,000 number of shares. Okay. And then they say that the company has issued two shares, like parent has issued two shares for every five being acquired. So I will divide by five and I'm going to multiply by two. So on every five, the parent is giving its two shares. Okay. And the value of the share of the parent at that date is 1.8. So we need to multiply it by 1.8. So that's the formula which I have used to find out the share consideration. Okay. And we get a total of 2160. I can break up the steps for you over here. So the number of shares is 5,000 divided by 1 because that's the nominal value. So you get 5,000 number of shares. We have acquired 60 percentage of that. So that makes it to 3,000 number of shares. And on every five, so divide by 5, the parent company has issued two shares. So the number of shares which has been issued by the parent is 1,200. And as the market value of those shares is 1.8, so I need to multiply this by 1.8. So that turns out to be 2160. So this 5,000 is basically the total shares of S company. Okay. This is the shares acquired. Okay. This is the parent company's shares issued. And then this one would be the market value of it. So in case if you have to pass the entry for it, it will be debit investment in subsidiary with the amount of 2160. Okay. Credit will be share capital, but this will be with the nominal value. So that's like 1,200 shares. So 1200 into 1, you get 1200. But then the rest would be the premium. Okay. So share premium will be the difference, which is, you can say, 1200 multiplied by zero point 0.8. That's the premium being paid. So that's 960 over there. Hope that's clear. Now, moving further, what we have is your deferred consideration. Okay. That's something which you're going to be paying like after 3 years, I believe. Yes. And that's 2000. And the interest rate is given to at 6%. So for that, what we have to do is 2000 into divided by 1. Sorry, 2000 multiplied by the discount factor at 6% for 3 years. So for that, it's going to be 1 divided by 1.06. That's the rate of interest to the power 3 for the number of years. So you get there around 1679. Okay. Or we can say to 1680, for example. Oops. Yeah. So for this, the entry will be debit investment in subsidiary with the amount of 1679 or 1680. Credit would be deferred consideration with the amount of 1679. So you see, while we are consolidating, the debit side will be automatically being cancelled on consolidation because you don't report the investment within yourself when you're representing these two companies as one, as a single entity. So these will be cancelled off. But however, the credit side is something which you need to take care of, you need to record while you're consolidating the balance sheet. So I will come back again on this step once we are at the preparation of the balance sheet, like once we have done completed our workings. So anyways, so here the total cost of investment, what turns out to be is 5000 plus 2160 plus 1679. So that's the total cost of investment. And from there, we have to subtract the share of net assets. So it's parent share in net assets of subsidiary at the date of acquisition. Okay. And that is 60 percentage of 10,800. So 10,800 into 60 percentage. The net asset or the equity at the date of acquisition is 10,800 and the parent has acquired 60 percentage of that. So this means that the value of net asset which you can prorate towards the controlling part, towards the parent part, is 6480. But as we have paid 8839 for it, so the excess what we are paying is considered to be as your goodwill. And this goodwill relates to only the controlling interest, which is of 2359. So in case if the question would have been simply at the proportionate method way of writing down the goodwill, so you should have stopped your working number 3 till here, and the answer would have been 2359. But because in this case, they are going with the full value method, so we have to take the fair value of NCI. Like this is the market value of the other 40 percentage, which is not being acquired by the parent right now. And for the fair value of NCI, it's already given to you in the question, which was 5750. So I will just simply write down that figure 5750. And likewise, I'm going to subtract from there the NCI share of net assets of subsidiary at the date of acquisition. So in that case, it's going to be 10,800 into 40 percentage because 60 percentage belongs to the controlling interest and the other 40 percentage belongs to the NCI. So that's 4320 over there. And as the market value is up to 5750, the difference will become the goodwill for the NCI. And in that case, it's going to be 1430. Therefore, so this one was a working for 40 percentage, which is for the NCI. And the total goodwill in this case would be 2359 plus 1430. That's conclude us towards working number 3. We got a total goodwill over here of 3789. And now we will move towards your working number 4, which is NCI. Okay. So in to find out the value of the NCI, we have to take the value of its net assets as well as the value of the goodwill. So goodwill is straightforward. We just calculated it right now at 1430. So we just need to write it down over there. But as far as the net asset is concerned, I told you that from working number 2, you have to take the figure, which is at the reporting date. So the net assets of the subsidiary company at the reporting date are uh, 12,200, and the NCI enjoys a share of 40 percentage. So I'll multiply it by 0.4, 40 percentage, and I'm going to get 4880. So that's the value of the net assets which is attributable towards your NCI, and their share of goodwill is 1430. Therefore, the total value which comes for the NCI will be at 6310. Yeah. And that's the end of our working number 4, which is to find out the value of the NCI. Now, the last working before we make up the balance sheet would be to find out the group retained earnings. Okay. And for that, we have to take parent first. And like we're talking about a group, so we represent the parent represent itself. So that will be at 100 percentage. And the parent's retained earnings at the reporting date are 12,500. Okay, so that's 12,500. But for subsidiary, you have to take the post acquisition share. So share of post acquisition. So as I told you that in post acquisition, it has been 1400. The difference between the net assets of the subsidiary at the acquisition date and then at the reporting date. So we have to take this 1400 and we have to give our share, which is 60 percentage. We have to take that. So that will indicate to 840. So now in previous videos, like I mean, that was it towards the group retained earnings. But in this case, we just have one slight more adjustment over here, which is to account for the unwinding of discount, because you have written a liability of 2000 at a valuation of 1679, right? So we have discounted, and over the period of time, like this is the retained earnings, what you're making is at the balance sheet date. So it has been 1 year past, and you need to unwind the discount. And that will be considered to be as an expense, as a finance cost if you're making your income statement. But in this case, as we are making up the balance sheet, we have to account for it into the group retained earnings. Okay. So for that, we have to, now these are certain adjustments which we have to make. Over the period of time with more videos, you will find out more adjustments being done towards the group retained earning. But for right now, what we have over here, the first adjustment would be the unwinding of discount. Okay. 1 second. Yeah. So that's the unwinding of discount. We wrote the liability at around how much? 1679, correct. So we need to charge 6% interest on that, because that's the rate at which you have done the discounting. So if I charge 6% interest, the finance cost will be 101 to be exact. Okay. So it will reduce your group retained earnings. So 13340 minus 101. So the one which you will report in the balance sheet will be 13239. Okay. And for this, your entry will be debit. The finance cost if you're making the income statement, or group retained earnings if you're making the balance sheet, like in this case. And the credit will be your deferred consideration. So now we won't be writing down the deferred consideration at 1679. Okay. we have to add up your 101, or you have to increase it up by 6 percentage, and that will be the deferred consideration balance which you will be reporting in the balance sheet. So now once we have completed all our five workings for the group structure, the net assets, the goodwill, the non-controlling interest, and the group retained earnings, finally it's time to merge them together and to make your balance sheet. So in this case now, see, here's your P group, okay, your dollar, right. So for non-current asset like the property, plant and equipment, I just simply need to multiply 50, add 15,000 and 9,500. So that will give me 24,500. These investments, which is 5,000 worth of cash within the subsidiary, will get cancelled with the share capital and the retained earnings at the date of acquisition, and it will create something called as your goodwill. So the investments will be replaced by the goodwill, and your goodwill, as you have calculated already, the total goodwill, which was 3789, will be shown as a non-current asset in the consolidated statement of financial position. As far as your current assets are concerned, you just have to add them 7,500 and 5,000, so that makes it up to 12,500. And your total asset will be 24,500 plus 3789 plus 12,500. So this gives me a total assets of 40,789 to be exact. But then you have to come up on the share capital, the equity part. Now, in this case, you have to be careful that the shares which the parent have issued in order to acquire the subsidiary were not being recorded, right? It was given to you in the question. It says that P has only recorded the cash paid in respect of the investment. So it means that the deferred consideration and the share consideration were not being recorded. And that's what you have to do while you're consolidating the balance sheet. Okay. So in this case, you will just take your 6,000 plus, as you remember, that we credit the share capital with 1,200. Okay. So we will increase the share capital by 1,200 because these are the shares which the parent has issued in order to acquire the subsidiary. Subsidiary share capital will not become because we just cancel it with the investments of the parent company, and it created a goodwill. Okay. As far as share premium is concerned, though subsidiary doesn't has a share premium, but as far as the parent is concerned, we issued some shares at a premium, and if you remember that we issued 1,200 shares at a premium of 0.8. So we already calculated that figure here, which was at 960 over here. Okay. So that's the same 960 which I'm adding. So this will become a total of 4,960. As far as the group retained earnings are concerned, you just have to bring it from here, which is 13239 after the adjustment of unwinding of discount. But here we have to add up something called as the NCI. Okay, so that's what you need to take care of while you're consolidating, because this is the part which is not being controlled by the parent. So the NCI value, what we calculated was 6310. So I'm going to write down over here 6310 here, working number 4, made up of the net assets and the goodwill share of the NCI. So that's what we got the total equity over here. Okay. I'll just add up one line. Yeah. So the total equity, which turns out to be is share capital, share premium, retained earnings, and your NCI. So that brings up to a total of 37,109. I'll just add up one row over here. Yeah. Okay. So we can put it here. 72 plus 4960 plus 13239 plus 6310. Right. So now we have your non-current liabilities. So for non-current liabilities, what you simply have to do is you just add up both of them. But then you remember that you had a deferred consideration, okay, which initially was at its present value here. Deferred consideration, this is a non-current liability because we have to, the parent company has to pay it after 3 years. So that's like 1679, and then because of the unwinding over the period of 1 year, the value increased by 101. That was the unwinding of discount. So now the total value of the liability turns out to be 3280. For current liabilities, you just have to simply add both of them. So 4000 plus 1800, it will become 5800. And now if you add them together, it supposedly should be equal to 4789, which is the total of your assets. So 31709 plus non-current liabilities and plus your current liability. So this gives me again over here, which is 40789, and here also it gives me 40789. Hence, it means our balance sheet is correct technically, and as it's tallied out. Hope that's clear. If you have any questions, please feel free to ask me. You can comment, like, and subscribe. Thank you very much.